on the vertical scale is or rather on the horizontal scale, is the time period just prior to expiration. At right around 30 days to expiration, the value of that option drops off dramatically as it gets closer to expiration. Actually, the option begins declining and decaying in value as far out as 100 days. But the acceleration really takes place about 30 days to 40 days before expiration. So that's how we make our money. Basically, those options are decreasing in time and value the closer we get to expiration, and that's how we capture our profits. Now, we can enter this as individual orders, but remember, just like our vertical spread, there's a danger in entering individual orders like this. One of them may get filled, the other one won't. And if that should happen, then we'd have a problem because we would be naked one of these options. So let's go back to our Trade tab here, and let's select the month that we want to sell. In this case, it's June. We'll go to the June expiration, and in the Thinkorswim platform, it's very easy to simply right-click, and we go to Buy Calendar. And it automatically brings up for us the very next 2 months. The first month is the front month of the option expiration cycle. In this case, it's June, which is the one that we want to sell. But it also brought up the June quarterly options, which is the ones that we do not want to buy. We actually want to go to July. And I'll tell you why in just a few minutes. Now, the price for this calendar spread is $1.29. Let's go over to the Analyze tab. And you can see that the graph is identical to the one that we had before, in which we were purchasing the back month option in July and selling the front month option in June. The only difference is that we can enter this order as a spread order so that it will be filled at the exact same time. The maximum profit of this position as a calendar spread is the strike price that we are buying it at, which is 138. As the price moves away from 138, we will make less and less profit. However, it also has limited risk. In this case, the most we can lose is $129. And it's also the margin required on this position from our broker, because they know that the most we can possibly lose in this position is $128. And that's all that they're going to ask us to set aside to put this position on. Now, I mentioned that the position itself has a maximum the maximum loss on this position is $129. As you can see from this graph, because that's the margin requirement, and also on the graph you can see that it doesn't matter how high the price goes, it's $129 loss maximum, and it doesn't matter how low the price goes, it's $129 maximum loss. The maximum profit is if it continues to be right at the center. Then we'll collect the maximum amount of profit from this position. The maximum profit from this position is achieved at 138 because that is the option that we sold, and it also has the most extrinsic value, $2.61 in this position. I showed you the time graph. What happens is the front month of the option, and the reason that we make money on this position is that the front month option will decline in value faster than the month that we're buying. They will both decline in value if the price does not move the closer we get to the June expiration. The difference is that this option in July, the one that we're buying to protect our June position, will decline at a slower rate. The difference between the decline of the June option and the decline of the July option is our profit. And that's how you make money on a calendar. We can also discover something very interesting. In the Thinkorswim platform, you have this little box right in the center above the calls and the puts. if you click down into this blue link here, you can actually call up all of the calendar spreads for this particular month. Let's take a look at these. Let's go back to our June options. There we are right here, June, July's. Yeah, it looks like they give us a little bit more options on... They don't give us as many options in here for some reason. Well, let's just for example, let's take... Oh, here they are, June, July's. I'm sorry. Okay, just got the wrong box pulled up. There we go. June, July. That's the one that we're doing. We have 37 days before June. We have 55 days to July. And the current price of the SPY is at 137. So let's go exactly to the 137 strike price. You can see that the farther out of the money on either side, the least expensive the calendar spreads become. So, for example, if we were to purchase the 145 calendar spreads, June, July, that means we're selling the June 145 calls, we're buying the July 145 calls. The price that we would pay is 65 cents. Let's delete this out and just click buy on this. It automatically brings up those two options for us. Actually, we want June, but anyway. How did they do this there? Oh, they got the June 05s in there. That's why. I did have the right one. Sorry, I'm talking to myself here. Let's see. I don't know why they don't have a lot more strikes on this one. Let's see, July, August. Well, they're not going to have all the ones that we want, but I'll use this as an example, okay? And the principles are exactly the same. So let's say let's say we're bullish on a particular stock, and we believe it's going to rise in price. Well, instead of buying an outright call, we could also buy a call calendar, a calendar spread. The reason for that is, again, we have a maximum loss because we're protecting. We're also purchasing a call to protect us. In this case, is the June quarterly calls. So what we want to do is we want to purchase a very cheap out-of-the-money call calendar spread for 60 cents. I call this a bullish calendar spread because as the price rises towards the 145 strike level, that means the SPY would have to go up from 137 to 145. At 145, we would achieve our maximum profit. And you can see that that's true if we look at the current price of the stock. It's at 137. The most expensive call calendar spread is at the 137 strike price for $1.10. So the way we make money with a calendar is if, in fact, the price of the underlying stock expires exactly at the strike price that we've sold. So if it were to rise up to 145, this 60 cents would then become $1.10, and we would make our maximum profit. Let me show you how that looks on our profit picture. If we go to Analyze Duplicate Trade, we're going to get rid of our other one here. This is called a bullish calendar spread. The actual price, the current price of the underlying stock is down here at 137.64. In order for us to make our maximum profit, the price of the underlying stock would have to rise all the way up to the 145 strike, which is the one that we're selling and the one that we're buying.